Good morning. Thank you for joining us for our Capstone Coffee conversation. As we've hit the midpoint through the year, we thought it'd be a good topic to give people a little update on what we've seen has been kind of key contributors throughout the first half of the year, where stock and bond markets stand today, and then what we can look to going forward for the next 6 months. So I'll do a little bit of the overview of kind of just what's the broad base, what's been happening. Brian will give an update on what has happened in the markets for the first 6 months, and then we'll kind of piggyback and go on what we see for the next 6 months. The first part I'll kind of breeze through somewhat quickly, as we've all are keenly aware of the mishaps throughout the first half of the year. But we began the year with stocks at an all-time high on January 2nd. Yields on fixed income were extremely nominal, about 1.5% to begin the year on a treasury bond. The Fed had not raised rates yet at all, and inflation was right around 7% for December, after finishing the fall somewhere in the mid sixes. So inflation was 6.5 through the fall, hit 7% in December, and the Fed had not raised rates yet. Now, as we go through the first 6 months, inflation has gone from 7 to today 8.8%. Stocks went from slightly expensive to now maybe more fairly valued. The Fed has raised rates 3 times to the tune of 1.5%. The fixed income rate has gone from 1.5 on a 10-year treasury to about 3% today. COVID continues to wreak a little havoc, mostly in some developing countries. China still has Shanghai closed down parts of the first half of the year. And then we also had a war that began in Europe with Russia invading Ukraine. So the first half of the year had quite a bit of change, not much of that being market friendly.
As a result, some key statistics for you. The S&P 500 has been down about 20%, kind of bouncing around that 20% mark. Core US bonds have actually come down about 10% as well. Inflation, we had a new inflation print this morning, year-over-year change 8.8%. And the one highlight, I guess you could say, the one ray of sunshine has been commodities have performed very well. And for example, the energy sector has been up about 30% for the year. So a big divergence in a lot of returns for the year than we normally see.
So as we look at history, we're trying to figure out, where do we go from here? What has happened in the past when we've seen markets behave like this? And it's been a very long time since we've seen stocks and bonds have catastrophic years so far at the same time. Typically, when stock markets are declining, we might have bonds that are kind of buoy in the account, but that's been the opposite this year. So we look back at history, and there's been 5 times when the stock market, the S&P 500, lost 15% or more in the first 6 months of the year. So it's happened 5 times, now it's happened 6 times. The previous 5 times, the second half of the year was positive each of those 5 times. So from July 1st to December 31st, had a positive return each of those 5 times. It never probably feels like that's the way it's going to go, but each of those times after the market was down 15%, it probably didn't feel like that either. The average return of those 5 other markets was plus 24% from July 1st to December 31st. So typically, historically speaking, good returns have come after some catastrophic times. One other data point that I'll give you, we track the Consumer Confidence Survey, and it comes out monthly, and it basically is a survey that goes out to households and it asks people their opinion on stock market, economy, and the direction of the company, and it comes out with a reading. And the average reading for the Consumer Confidence Survey is right around 86, and that goes back 50 years. So the average reading is approximately 86. We have today a consumer confidence reading of 50. That number is the lowest consumer confidence number in the history of this 50-year chart. In other words, Americans are more pessimistic today than they have ever been in 50 years. And so we went back and looked at, well, what do markets do when people are either really optimistic or really pessimistic? And so we looked at some inflection points. And if we look at kind of the 8 other lowest times of inflection points where people were the most pessimistic, all the way back to 1971, the average return for the next 12 months was 25%. So that's a pretty good return, again, when people are at their most pessimistic. And I think what that chart is telling us is that when people are very pessimistic, the sellers have sold. The people who are going to be out of the market have sold, and the sellers kind of run out of steam. And then even news that might not be good news, but as long as it's a little bit less horrific, we start to have a little rally. So it doesn't mean that markets are turning around this month or next month, but when we look at 12 months can feel like an eternity sometimes in politics and investing. And so 12 months from now, historically speaking, that bodes well.
So the major story of this year has been the Federal Reserve's response to inflation. How are they going to raise interest rates, and how fast or slow are they going to do that to try to combat inflation? And a lot of clients have heard my Top Gun analogy. I won't spoil anything in the movie if you haven't seen it yet, but there's a scene there where the pilots have to fly through this canyon and they have to get to their destination in a very short amount of time. So they have to go very fast, but they can't fly very high because they have to stay away from the enemy radar. So it's this near impossible task, and they have to fly through this canyon at high speeds. And I use the analogy that that's a lot like what the Federal Reserve is doing right now. They have to raise interest rates to try to combat inflation, but they want to go fast enough that they can keep up with inflation, but they don't want to go too fast that they actually put the brakes on the economy enough to go back into a recession. And I think what you're seeing is a lot of the fears of that have drawn the market down as interest rates have risen. It doesn't necessarily mean that we will tip into a recession or we will have higher inflation. They could actually walk this tightrope well, and that's what they're trying to do. And they've tried to be very transparent about how that's going. The latter half of the year, we'll see inflation come in and be in response to a lot of the interest rate hikes, and we'll see how that's actually going.
Yeah, we hear a lot of talk about, are we in a recession? Is a recession looming? When's the recession starting, et cetera, et cetera. We might already have had a recession. These first 2 quarters, the first half of the year, by all kind of measures that you look at, were pretty recessionary. And so a recession never gets announced while it's happening. It's always hey, by the way, 3 months ago, we were in a recession, as it's announced later. We could have just completed a recession. We might be in the recession now, but I would not be surprised to see that the first 2 quarters, we are actually in a recession. The stock market bottoms before the recession bottoms. So the stock market always being somewhat forward-looking. If we're in a recession now, that doesn't necessarily mean that we have to expect more pain for stocks. Again, we could still be in one. It could be one again next year. It's it's kind of uncertain times, but that word gets thrown around a lot, and I don't think it's a word necessarily that we need to be scared of or anxious about, because we could already be in a recession. We also have election coming up in the fall. Brian was mentioning, the inflation numbers kind of ramping up in the fall. Elections coming in the fall. By all kind of points that we see, it looks like we could be heading for some type of split government. And the stock market typically likes a split government. So far, this last 2 years, one party has been in charge of all Congress and executive branch. That is usually not the leading, historically, usually not the best stock market performing years, but a split government, typically the stock market can appreciate more of a stable government when we have division of power.
So the big question that we get a lot is, well, what do we do? And the main one is, Brian and Ryan, should I sell everything and go to cash? Well, obviously, if we knew with 100% certainty exactly what's going to happen, we could act accordingly. And if that was the answer, that was the answer. But because more often than not, you're going to get that wrong of that timing of when I should sell everything or buy back in and everything, that's usually not the right answer. The right answer tends to be to first have your portfolio constructed in a way that you can weather the storm depending on your time horizon. Every client, every investor has a purpose for why they're investing. And it could be retirement, that's a long way off, or it could be income I need this year or next year or the next couple of years. So the first thing to do is kind of assess what is my time horizon and are my investments matching that goal, and to invest accordingly. The other thing is that Ryan and I have been focusing on having portfolios move to more higher quality companies that have the ability to raise their prices and they have low debt and they have high free cash flow so that if times do get tougher, they are more built to weather that storm along the way. The last piece that we'd say is to not overpay for a company. A lot of investors can get trapped in what's called chasing returns. The company did really good last year, so if they think if I buy it this year, I'll get that same return. That's not always the case. We still want to be aware of what are we paying for stocks and what are we paying for US companies versus international companies, and how does that affect our investments?
I do want to, I'm going to say one more thing, but if you have any questions, please chat, send a message to the host, and Jackie back here will read those off. So if you have any questions you'd like answered, please feel free to start sending those. Sorry, I should have warned you about that at the beginning. As Brian was just mentioning, we try to be very proactive, and proactive does not mean jumping in or jumping out, right? Proactive means leaning a portfolio. Again, if there was 100% certainty, then we could jump in or jump out, or we have 100% of our eggs all in one basket. But being proactive means this is where we see value in the marketplace. Historically speaking, this is a good return on our investment, and we'll lean a portfolio that way. So very proactive, but not proactive in ins and outs of a full portfolio, because that has shown over time to not benefit, increase costs, and typically the average person gets that wrong. And we would include ourselves in that average person. This market can humble you very quickly, and we want to make sure that we're kind of doing historically the best thing for all of our clients' accounts rather than moving things on a whim in that nature. Any questions, Jackie, that you have?
We do. We have a really interesting one, actually. Okay. Do you guys have anything to talk about crypto investments, or is that something more that you're going to have a one-on-one conversation with the client about?
Yeah. Want me to do it? You got it.
Well, I'd say we have a funny saying in my family that situations are situational. And it's kind of said tongue in cheek, but it depends on your situation. Crypto could be appropriate for some investors. It might not be for others. It's certainly come down like a lot of the market has.
Yeah, I'd say the prices are compelling now. I was kind of avoiding it when Bitcoin, for instance, was pushing 70,000. Today it's hovering around 20, and it's been there for a while. It's trying to find a bottom potentially, but I think it should be very measured. The saying that I have used in the past, the second most foolish thing you can do is to own too much crypto, and the first most foolish thing you can do is to own none. So that's, I like it, but very measured.
And what would you guys consider a good buy right now?
Well, I think that goes back to the question about what do we do now, right? And I mentioned don't overpay for a company. And I think US stocks have become much more attractive than they were 6 months ago. But again, that's going to vary depending on your time horizon. If you're a very long-term investor, historically 20% maybe, has been a pretty good discount, but there are still a lot of risks out there. So it's going to depend on your situation. I think talk with your advisor. There could be some good opportunities, but for others, maybe not.
And I would say the one thing that has changed the most for me is that we are now starting to make money on safe money. And 6 months ago, we could not earn much of anything on bonds, cash, fixed income of any type. It was very sparse to earn a return. And so that kind of forced people in maybe to owning more stocks or doing some alternatives or other things. But now rates have gone up quite a bit very quickly. And so now we're actually starting to earn some money on fixed income more than we have maybe even in the past 10 years. So that's becoming a little bit more attractive to me. Anything else?
No, that is going to be it.
Well, we appreciate you taking the time to join us for these Capstone Coffee conversations. This is just a way that we can try and get messages out to clients. We love to have these conversations with people throughout the quarter and throughout each month. And so these are some of the points that we keep kind of addressing with people. And so thank you for joining us. We're trying to do these each month. So we'll give you a topic for the next month, and we'll see you then.